Chapter 2. Introduction to Dow Theory. 2.1 Origins and Proponents of Dow Theory. Charles H. Dow is credited for much of the early work that led to what is known today as Dow Theory. 2.2 Basic Assumptions of Dow Theory. There are 6 basic tenets of Dow Theory, namely: 1. The averages discount everything. 2. The market has 3 trends. 3. Primary trends have 3 phases. 4. A trend persists until its reversal is indicated. 5. The averages must confirm one another. 6. Volume must confirm the trend. In addition to the 6 basic tenets, only closing prices are recognized in Dow Theory. The averages discount everything. Pricing in information. It is believed that the market discounts everything except acts of God. This means that the market is the end result of all participatory action, which represents all information that may be known to the markets. The mechanism by which information is known to the market is that of actual participation via capital injection. Figure 2.2 shows the gold market adjusting very rapidly to information about the same event. Price is the ultimate reflection and embodiment. Figure 2.2 shows the gold market adjusting very rapidly to information about the same event. Price is the ultimate reflection and embodiment of everything that is knowable. The market has 3 trends. The Handbook of Technical Analysis. The second assumption of Dow Theory is that the market The Handbook of Technical Analysis. The second assumption of Dow Theory is that the market comprises 3 trends. Robert Rear explains, in his book The Dow Theory, there are 3 movements of the averages, all of which may be in progress at one and the same time. The first, and the most important, is the primary trend, the broad upward and downward movement known as bull or bear market, which may be of several years' duration. The second, and most deceptive movement, is the secondary reaction, an important decline in a primary bull market or a rally in a primary bear market. The reactions usually last for 3 weeks to as many months. The third and usually an important movement is the daily fluctuation. Summarizing, the market is believed to express itself as 3 distinct trends, namely: 1. Primary trend, major trend, lasting from months to years, long term. 2. Secondary reaction, intermediate trend, lasting from weeks to months, medium term. 3. Minor trend lasting for days to weeks, short term. See figure 2.3. 1. The primary trend. The largest trend is by far the primary trend, which is normally expected to last from months to years. There are 2 types of primary trends, namely: 1. Primary bull trend, bull market. 2. Primary bear trend, bear market. In Dow Theory, an uptrend is defined primarily as successively higher peaks and troughs. According to Dow, it is more important to participate in a primary bull or bear trend once it has been confirmed or once it proves that it has the strength to penetrate old peaks or troughs. The secondary reaction usually retraces from 1 to 2/3 of the primary trend range. Any retracement volume usually signifies that the correction beyond 2/3 on high secondary reaction may in fact be a new primary bear market. The minor trend. The minor trends are not regarded as important in Dow Theory. In fact, Hamilton commented in his book The Stock Market Barometer that the stock market is not logical in its movements from day to day. Lines are simply Lines are simply narrow horizontal ranging formations on a daily chart. They are usually formed in anticipation of some significant news or economic announcement. These narrow consolidations usually result in strong breakouts. Dow theory recognizes lines as potentially profitable formations even though they are essentially regarded as minor trends. Primary trends have three phases. Primary or major trends have three phases. A primary bull or bear market consists of the following three phases. 1. Accumulation phase. 2. Trending phase. 3. Distribution phase. Accumulation normally occurs after a lowing company releases very negative data. The uninformed market participants are usually extremely bearish at this point, selling off whatever shares they have left at any price available. The accumulation phase normally lasts longer than the distribution phase due to less capital and profit at risk. Deep and rapid decline in prices fall. The trend phase consists of the uptrend and downtrend phase. The uptrend phase is driven by market participants expecting higher prices after an accumulation. The uptrend phase tends to last longer than the downtrend phase due to less capital and unrealized profit at risk at lower prices. The downtrend phase normally starts to accelerate as more companies start to report increasingly bearish news. A trend persists until its reversal is indicated. In Dow theory, a trend is assumed to persist until there is evidence to the contrary. Trend changes are identified by a penetration of a previous significant peak or trough. 1. Failures. 1. Failure swings. 2. Non-failure swing. Double tops bottoms. The term failure swing was first used by Wells Wilder in his book New Concepts in Technical Trading Systems, when describing the oscillator swings on the Relative Strength Index (RSI) indicator. The averages must confirm one another in Dow theory. The averages must confirm one another in Dow theory. There is a requirement that both the industrials average and the railroad average must extend beyond their secondary peaks in order for a trend to be established, that is, the trend in on average must be formed by the other. Average. In figure 2.20, we observe that the In figure 2, average. In figure 2.20, we observe that the industrial average penetration its secondary The averages must confirm one another in Dow theory. There is a requirement that both the industrials average and the railroad average must extend beyond their secondary peaks in order for a trend to be established, that is, the trend in on average must be formed by the other. Average. In figure 2.20, we observe that the industrial average penetration its secondary peak at T1 while the railroad average penetration its own secondary peak a little later at T2. Hence the uptrend was only confirmed at time T2. As far as Dow theory is concerned, the uptrend was not confirmed until the railroad average penetration its own secondary peak at T2. In figure 2.22, we observe that the Dow Jones Industrial Average experienced a weak non-failure swing sell signal, signifying a change in the trend. Volume must confirm the trend. Expanding in the direction of the existing trend means that Expanding in the direction of the existing trend means that 1. In an uptrend, volume should be increasing. 2. In an uptrend, volume should be decreasing during a downside retracement. 3. In a downtrend, volume should be increasing. 4. In a downtrend, volume should be decreasing during an upside retracement. Is not met, the existing trend may be, if any of the 4 conditions listed above, potentially weaker than expected and may lead to a reversal in the existing trend. In figure 2.25, we see volume in area A on the chart expanding in the direction of the existing primary bull trend in gold. Only closing prices are recognized. In Dow Theory, only closing prices are recognized. This means that regardless of how large the high and low price excursions may be on any one day, only the final closing price will be used. 2.3 Challenges to Dow Theory. There are many criticisms of Dow Theory. Here are some of the most significant arguments against it. 1. Dow Theory is more applicable to the equity markets. Detractors of Dow Theory argue that the theory is unsuitable for application in faster moving markets or across lower time frames. Monetary policy such as near zero interest rates set by central banks over extended periods combined with colossal stimulus packages and quantitative easing K to infinity type operations impact the longer term action of the markets by creating an artificially super bullish environment where even its participants have little or no fear of anything untoward happening to the markets. 4. Only closing prices are recognized. Recognizing only the closing prices notes potentially large intraday ranges that may occur during the day's trading session. 5. The buy and sell signals based on the primary trend are safer. This may or may not be true, but detractors of Dow Theory argue that such signals usually occur late in the trend and miss a large part of it. Underperformance in either the industrial or transportation average leading to non-confirmation would logically signal potential trouble in the economy. Unfortunately, the Dow Jones Industrial Average today is composed of many stocks that do not produce any physical product that requires shipping or transport in general. Many of today's companies are more involved in financial products, telecommunica. 2.4 Chapter Summary. As we have seen, Dow Theory forms the basis for much of technical analysis in the 21st century.